silver just split into two different realities. On one screen, it's calm, controlled, about $71 an ounce. On the other, in the real world where metal actually changes hands, silver is blowing past $100. In Japan, verified physical trades are clearing near 130. In Kuwait, it's over 100. In China, the same story. Same metal, same day, two prices that no longer recognize each other. That contradiction isn't a technical glitch, it's a signal flare. Because every market you trust assumes one thing, that the price means something everywhere. When that stops being true, money doesn't behave normally. It rushes, it hides, it breaks rules you didn't know existed. And this hits you directly. Your savings, your purchasing power, your exposure to systems built on the price all depend on whether the real price or the screen price wins. Most people don't even realize a split has already happened. But here's the part nobody explains clearly. This separation didn't happen by accident. And once you see what forced it, the entire market looks different. What's happening didn't start with one spike or one headline. It's the visible break in a system that was already under stress. As of early January 2026, the global spot price of silver still exists on paper, mostly set through Western futures markets like COMEX. That price claims to represent the value of silver everywhere, but it no longer does. Here's what matters. In Asia and the Middle East, buyers aren't negotiating off a screen price anymore. They're paying whatever it takes to secure actual metal. Japan, Kuwait, China, different economies, same outcome. Physical silver is trading far above the Western quote, and the gap isn't closing. Historically, this kind of spread would trigger arbitrage. Traders would buy cheap, sell high, and force prices back into alignment. That mechanism is gone. Not slowed, not stressed, gone. Logistics failures, physical scarcity, and export controls have slammed the arbitrage window shut. The paper market is still talking to itself, while physical markets are operating under a completely different logic. So here's the question that reframes everything. If the global price no longer reflects where the metal actually is, who is the price really for? By the end of 2025, something happened that nobody expected. China, already the dominant player in the silver market, made a move that could change everything. They rejected an urgent request from the United States to purchase 50 million ounces of silver. Not just any purchase. This one was supposed to be paid for with U.S. Treasury bonds, bypassing the traditional financial system entirely. The reason they rejected the deal isn't just about the price. It's about leverage. It's a geopolitical maneuver. And China isn't just selling silver anymore. They're holding it hostage. Here's where it flips. By refusing to honor the U.S. request, China signaled to the world that they control the future of silver. They're hoarding it for their own needs, sure, but they've also locked the West out of the game. This isn't a mere trade dispute, it's a blockade. And now the US and Europe are scrambling to get their hands on metal that isn't there. What does that tell you? The central planners in the West can't control the physical asset anymore. China's grip over 60 to 70% of the global silver supply is real, and it's not letting go. With silver prices surging, something dark started to unfold behind the scenes, a silent liquidity crisis in the banking system. As silver's price exploded, banks found themselves trapped in short positions they couldn't cover. And on December 31st, 2025, the panic became undeniable. Financial institutions scrambled to the Federal Reserve's emergency repo facility, tapping a massive $74.6 billion in overnight liquidity. Here's the simple math behind the panic. These banks had sold silver at $30 or $40 per ounce. Now, to cover the same contracts, they're facing a replacement cost of $70 to $130 per ounce. It's not just a small gap, it's a massive black hole in their balance sheets. And the moment silver moves from paper promises to actual delivery, these institutions are stuck. Now, let's talk about unrealized losses. Banks thought they could suppress the price, but now they're fighting a battle they can't win. Investors are demanding physical delivery, and the metal just isn't available. The supply is vanishing, and every ounce is now costing them far more than they ever expected. This is the point where the system starts to show cracks. If these losses keep stacking up, we're looking at systemic contagion, the kind that could pull down entire financial institutions. What happens if this keeps escalating? Retail investors are feeling the heat too. Across the United States, a frenzy has taken hold of the silver market. In shops, the shelves are empty. Dealers are reporting that inventory, which normally would sit for weeks, is disappearing within seconds of arriving. Customers are lining up hours before the doors open, and they're not just buying premium products, they're snatching up any silver they can find. Whether it's a collectible coin or basic bullion, the price doesn't matter. The only thing that matters is getting their hands on real silver. This isn't your typical market behavior, it's panic buying driven by the realization that currency is losing value. People are flooding the market, and it's not a rational decision anymore, it's fear. Fear that they'll miss out, fear that their money won't hold value for much longer. Dealers are overwhelmed, they can't keep up with the demand. Phones are ringing off the hook, but the supply chain is completely broken. The problem? There's no more silver to sell. The physical market has effectively seized up. What happens when that happens? What happens when even the dealers run out of inventory and the market simply can't supply enough metal? Meanwhile, the government's response to this silver chaos is making things worse. In Washington state, lawmakers made a drastic move by repealing a 40-year tax exemption on precious metals. As of January 1st, 2026, a 10.3% tax is now being levied on all silver and gold transactions. This new tax is a punitive measure aimed at discouraging the public from exiting fiat currency into physical assets. This isn't just a policy change, it's a shift in how governments are viewing wealth preservation. As the financial system crumbles under pressure, local and state governments are seeing the flight to safety as a threat to their failing budgets. And instead of protecting citizens' right to preserve their wealth, they're taxing it. But the real cost of this move isn't just the direct tax, it's the underground economy it creates. With the legal market becoming more expensive and cumbersome, black market exchanges for precious metals are likely to grow. The government isn't stopping the movement of wealth, it's just driving it underground. What does this tell us? The state, in times of financial crisis, may start criminalizing wealth preservation. The message is clear. The public isn't just losing faith in the dollar, they're losing the freedom to protect their own wealth. As silver surges, the panic isn't just confined to retail markets or banks. There's another layer to this crisis, the collapse of gold. Across the board, gold is vanishing from the market. Dealers are reporting zero gold in stock. Gold eagles, buffaloes, even basic bullion gone. The price for gold has skyrocketed, with some asking more than $4,500 per ounce. And even then, you can't find it. Here's the twist. As gold disappears, capital that would normally flow into gold is now flooding into silver. Investors who once relied on gold for stability are now looking to silver as the only accessible alternative. The gold-silver ratio, which historically balanced the two metals, is no longer driven by traditional market forces. It's now being forced into a new reality, where the lack of gold pushes people into silver, creating a new kind of demand-driven panic. This shift isn't just about the relative price between the two metals. It's about what happens when the primary store of value becomes inaccessible. Gold was supposed to be the go-to for safe haven investment. Now it's unobtainable, and silver is left to fill the void. This is a feedback loop. The lack of gold is driving more money into silver, which in turn pushes silver prices higher. But here's the real question. How long can silver maintain this role before it too becomes unobtainable? The situation with silver isn't just about speculation or shortages. It's about a deeper, structural problem that's been decades in the making. Silver, unlike gold, is largely mined as a byproduct of other base metals. That means when demand spikes, supply can't just ramp up overnight. Here's the kicker. Even though silver is trading at $70 or $100 per ounce, miners can't just dig up more. The mining industry has been hollowed out by years of low prices, leaving a massive gap in production that won't be filled anytime soon. New mines are not coming online in 2026. There is no silver production pipeline ready to flood the market. The existing stockpiles of silver are running dangerously low, and the only thing that will force the market to balance is a catastrophic collapse in demand, which won't happen until industries like electronics and solar power are forced to stop using silver. This is where things get truly dangerous. The supply cliff we're facing means that no matter how high the price goes, the actual amount of silver in circulation isn't going to increase. There's simply no way to respond to demand in the short term. So the question is, what happens when industries that need silver for survival can't get it anymore? What happens when demand doesn't just drive prices higher, but starts destroying the supply chain? 2025 marked a pivotal shift that's already rippling through the markets. The massive capital rotation from digital assets back into physical commodities, specifically silver. While cryptocurrencies saw a decline of about 17%, silver's price shot up by 148%. What happened? A realization hit investors. Digital gold has its own set of risks that can't be ignored when the world's financial systems are unraveling. Investors who were once drawn to the high volatility and potential gains of crypto are now seeking the safety of real assets. They're looking for something tangible, something that can't be erased with a single hack, regulatory shift, or currency crisis. And silver, with its dual role as a monetary metal and industrial asset, is filling that role perfectly. The entry of these new investors is accelerating the depletion of available inventory. These aren't retail buyers looking to stash a few coins for the future. They're large players accustomed to high volatility and rapid market movements. They're converting digital winnings into physical metal at a pace the system can't keep up with. So now the question isn't whether silver will continue to rise. The real question is, when the capital floodgates open for silver, who's left to sell it? What happens when all the available metal is gone and the buying spree doesn't stop? The industrial economy is now facing an existential threat. Silver is not just another commodity, it's the backbone of modern technology, especially in green energy and high-tech manufacturing. Solar panels, electric vehicles, and smartphones all rely on silver for their critical components. But here's the problem. The supply is disappearing, and the West has no stockpile to fall back on. As prices continue to skyrocket and China tightens its grip on the refined silver market, Western manufacturers are stuck. They need silver to power their green transition, but it's becoming unobtainable. Factories relying on just-in-time delivery are now finding themselves unable to complete orders. Some are turning to desperate measures, bidding higher and higher to secure the metal. Others are getting left behind as their suppliers run out. The green energy revolution is colliding with resource nationalism. China controls the lion's share of refined silver, and it's not sharing for industries that need silver to survive. This is a problem that goes beyond price. It's a strategic chokehold on their ability to function. So what happens when entire industries are held hostage by the availability of a single metal? What happens when the global supply chain for green energy tech crumbles under the weight of a metal that's simply too rare to be accessed at scale?